This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high-yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASX-listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing. I'm proud to say that this Rask podcast episode is brought to you by PIMCO, one of the world's leading fixed income investment managers. With more than 50 years of experience in navigating complex global markets, trillions of dollars under management, and a global team of experts, PIMCO is a name trusted by investors worldwide. Discover how PIMCO can help you build a more resilient portfolio at pimco.com/au. Aditya, thank you for joining me on the show.
Thank you, and great to be here.
Yeah, it's wonderful to chat here in the PIMCO office. It's a beautiful outlook behind us, and being here in Sydney, it's always just nice and refreshing to speak with people such as yourself. We're going to have a chat a bit about your background and a little bit about what you do day to day here at PIMCO, because I think people will be fascinated not just with the sheer size of the capital that PIMCO manages and that you manage, but also what goes into it. So I want to start with the simplest question of all. Now, you're a portfolio manager operating in fixed income here in Australia. We have a lot of equities managers on the show. I'd appreciate you just telling us, what does a portfolio manager in fixed income actually do?
It's certainly a little bit more intangible than say an equity manager. In a simple kind of form, we effectively invest the money that our clients entrust with us by lending it out to various entities. So we lend the money out to governments, to state governments, to agencies, to banks and other financial institutions, and to kind of regular companies as well. And so we lend that money out. It typically has a fixed term, and we're looking for that money to be repaid as promised, and we earn a certain amount of interest. So we seek to get the best amount of interest that we can get. And we've got to think about, when judging whether it's a good interest rate or not, we've got to think about and have a view about, what is the direction of interest rates going to be in a macro sense. If you have something that's paying 5% interest, that could be good because you think that interest rates are going to go down, and so locking in 5% now is a good choice. But if you think interest rates are going to be going up aggressively, then that may not be a good choice. So you've got to think about, what is the direction of interest rates, and then secondly, we've got to think about the credit worthiness of the borrowers that we lend to, and continually monitor that and how that's evolving. And I guess lastly, we have to think about how do we put everything together into a portfolio? What's the portfolio construction process? How do we build a kind of robust, resilient portfolio, which is well diversified and seeks to kind of maximize return and minimizing risk?
It seems like for people hearing that, lending money to the government, for people that are hearing this for the first time, it kind of sounds a little bit bizarre. So you're lending to the institution which governs the country, kind of thing. It's a bit of a twist for people. So one of the things that I think would help to kind of add some context to this is when we talk about share investing or equities and these types of things, we often think about like upside. A lot of people think about the upside first. Maybe it should be the other way around, but I'm led to believe it's the opposite. In fixed income, it's thinking about the risk, as you said, about the ability for them to repay and the credit worthiness. How would you juxtapose those two? So the equities manager versus what you're looking at as a fixed income manager.
Yeah, I guess equity managers are more concerned with the future growth of earnings, whereas we're kind of concerned about, is the borrower going to repay their debts at a timely fashion and pay their interest as well. So we're kind of more focused on leverage, on the indebtedness of that entity that we're lending to, their capacity to pay back the interest and principal. We're actually not too worried about, whether they're going to grow their business aggressively. In some sense, we'd prefer a kind of stable, just a stable kind of slightly more boring company that we have greater assurance will meet meet paying their interest and paying their principal, as opposed to one that's kind of aggressively going to try to grow and perhaps even borrow more money to finance that growth. So it's more about getting a steady source of income, and also bonds provide a defensive anchor to people's overall portfolios. So that obviously people have an allocation to growth assets via equities. But when things, go south, when economies slow, when inflation falls, when unemployment rises, when we go through these kind of periods of the macroeconomic cycle, then that's typically a time when bonds do really well and equities do poorly. So bonds provide a really good diversification kind of anchor and defensive anchor to people's overall portfolios. And the aim is really to construct something that during normal times is still rewarding you with an adequate level of income, something that's paying, well above the rate of inflation. So you're still preserving or building your purchasing power. But under downside kind of scenarios will do really, really well. And that's where it kind of fits into people's overall portfolios.
Yeah. So you're kind of like sticking to your knitting there, and knowing that the role that the fixed income is playing is predictability, whereas the excitement is all on that other side potentially with the growth side of portfolios. What are some of the, I guess, metrics that you might look at when you're judging either individual securities or you're thinking about the portfolio as a whole?
Yeah, so we kind of approach this, I guess there's two ways. There's the kind of top-down approach, which is more of a macro analysis kind of approach. And from that perspective, we're really concerned about the main kind of macroeconomic drivers of the economy. So growth, inflation, employment, and employment growth. They're the three big variables, and how central banks react to trends in those three key variables. And so just, if growth is high, then typically inflation rises, and that's an environment where central banks will be raising interest rates, and that's the environment that we saw coming out of COVID. We had a big inflation shock. Growth was running kind of above trend in a lot of places because of fiscal stimulus, and so central banks had to kind of press on the brake pretty hard and raise interest rates to curb that shock. And now we're on the other side of it, where growth is kind of slowing, inflation is falling back to central bank targets, employment growth is starting to slow down across most developed markets, and so central banks are now easing policy. They're cutting interest rates to try to support economies as we kind of normalize in this post-COVID era. So they're the things that we primarily are concerned with at a macro level. At a micro level, when we're looking at individual companies and borrowers, it's really coming back to the idea around leverage and sustainability of leverage of those companies. Their measures of liquidity, measures of interest coverage, and thinking about free cash flow from their operations. We're less concerned about the growth of future earnings. It's more about can they predictably, reliably, make their interest payments and principal payments even under a variety of economic scenarios.
Yeah, it's I think one of the things that's always really impressed me about PIMCO is that ability to have proprietary data, proprietary information, and blend the macro, and then with the bottom up, obviously. Can you talk to us a little bit about the macro level, how the investment process kind of starts, if that's where it starts, like from like who's involved, what happens as it trickles down through the organization?
Yeah, absolutely. Our process is really centered around 4 big strategy meetings that we have per year, quarterly meetings. One of them is, we call it our secular forum, which is really kind of taking a step back from the day-to-day of markets and what's kind of happening, and thinking about the longer-term trends that will be influencing markets. So not necessarily, we're not necessarily deriving strategies or trades from that. It's more thinking about the themes that will guide markets over a 3 to 5 year horizon. Right. One example of that is coming out of the great financial crisis. We had this kind of idea about new normal, which was that potential growth and inflation outcomes were going to be structurally lower around the world than they were prior to the GFC. And then resulting from that, we kind of had this notion of the new neutral, which is that kind of normal or neutral interest rates around the world were going to be much, much lower. So, that didn't mean that there was an immediate trade to do. It meant that over a multi-year horizon, we knew that our natural bias was whenever interest rates rose, that was an opportunity to buy the market, to buy bonds, to buy interest rate exposure, because we felt that the trend over time would be for lower and lower interest rates. Now coming out of a more recent kind of secular forums, we're thinking about the world transitioning to more of a multipolar world, a world that's characterized by, political and economic fragmentation and the consequences of that, with an increase in trade and potentially capital barriers and frictions. What does that mean for regional economies? What does that mean for how economic cycles might diverge across countries and regions? And then the portfolio implications of that. Other things that we're thinking about is just the level of sovereign debt around the world and the implications of that. And we think that structurally volatility is going to be a lot higher. So that's just an example of the thematics that come out from our secular forum. Our other 3 quarterly forums we call cyclical forums, which are really much more focused on the near term over a kind of 6 to 9 month horizon. And they start off with one day dedicated to our macroeconomic analysis. So we have teams, both economists and portfolio managers from around the world that converge to our head office in Newport Beach. And each team provides a presentation. The first day is really focused on macroeconomics. It's focused on GDP, on growth, inflation, employment outlooks, what we think central banks are going to do in each of those regions. And then the following 2 to 3 days are focused about distilling the takeaways from that macro outlook into what does that imply for markets? What does that imply for our portfolios? What kind of trades should we be doing? And we discuss the best trade ideas from each of our regions, and then spend a lot of time thinking about how do we put these best ideas all together into a robust portfolio. So the output of that process is deriving a kind of model portfolio, and then each region takes that model portfolio. It may tweak that model portfolio to suit the specific requirements of that region, what's happening in that region, the client requirements as well. But it'll be pretty well anchored to that model portfolio. And then between the strategy forums, on a day-to-day basis, we're continually monitoring economic data, events, upcoming new transactions, new deals. And just constantly, every day, checking our exposures, our risk, seeing how markets are evolving relative to our expectations coming out of that forum process, and continually asking ourselves, are we on the right track? Do we need to reconsider anything? And do we need to kind of manage our risk and our positioning?
It's interesting. Well, I shouldn't say interesting. It's actually when you think about that comment you made about the GFC, and the new normal coming out of the GFC. For folks that are old enough to remember, pre-GFC, interest rates are very high in the lead up to what ultimately became a housing bubble, right? But then to come out the other side and say, well, this is the new normal, and what you saw before is maybe going to be different to what we see now structurally. That's actually, it's easy for us to sit back now in hindsight and say, well, yeah, of course. But at the time, that would have been pretty profound, I'd imagine.
Yeah, absolutely. I think, as investors collectively, we have a sense of, we have a sense of mean reversion. We kind of look at recent history and recent trends, and whenever something happens that kind of breaks away from that, we kind of assume that we'll revert back to that original trend or that original kind of average. And that kind of can work. That does work most of the time, but then often you'll have such a big event like the GFC, which causes a big kind of structural break, and you're in a kind of new world. And like you said, you're not sure that you're there until many years down the track. So, that's where our process comes in. That's where, the Secular Forum, we invite a lot of external speakers, particularly on topics that we're not necessarily experts on. At the moment, you've got such an intrusion of politics and geopolitics into and influencing markets. So we get a lot of experts in those fields to come and inform those discussions and how those trends might play out. We have experts in, say, in the US, for example, who have deep knowledge of the political system, and they come in and they can give us very, very detailed analysis as to what type of bills might pass Congress, where the numbers are, what the likelihood is, what needs to happen. And so from there, we can then start to formulate views on fiscal policy in the US. And then from there, we can think about, well, what's the growth impact going to be in the US? What's going to be the impact on inflation? And then eventually, what's going to be the impact on interest rates, the direction of interest rates, and other factors like that. So that's really where our kind of strength in the process is borne out. And I think we are in that, potentially in another period where there perhaps has been another kind of structural break, and we're in a bit of a new era.
Interesting. I'll come to that in just a minute, but I should disclose for people that are watching or listening, we're actually investors at Rask. We're investors in the PIMCO Australian Bond Active ETF, just for full disclosure. What it really strikes me there is, and it reminds me of this, I don't know if it's just an investment myth or a financial myth, but I heard once upon a time that PIMCO has more data points than the Fed in the United States. And that reminds me that, having that type of insight at the time, and even more recently, right, having those data points and bringing all those analytics together, bringing all those minds together, the influence of politics in investing is so profound. And for people that aren't aware, the bond market isn't like the share market in that you're lending money, you're looking for securities that are 10 years to maturity, sometimes longer, right? So you're lending that money with a view that this has to work for our investors for a considerable period of time. Not always the case, of course, but that's really a really important thing to understand. One of the things I did want to pick your brain on, because you're here and this is what you do, is just getting your view on the Australian market as we are today, because we've had a lot of data points. We've had some interest rate cuts recently, but a lot of data points and expectations pointing to maybe more of that to come. And just this week, you hear of different policies put forth by the government here in Oz that make people question directions, and then you see data points that kind of contradict the earlier sentiment of maybe rates is coming down. So I'm curious, however you want to take this, whatever jumping off point you think about is appropriate, but just how you think about the direction of Australia's interest rates or just the market in general.
Yeah, sure. So maybe I'll kind of come to two main points. I'll first kind of tackle the question about interest rates. We think that the RBA eventually will be forced to cut interest rates a little bit below 3%. So somewhere between 2.5% to 3%, we think is a reasonable estimate for a landing point for the RBA. Mm-hmm. If we think about the risks around that kind of base assumption, we would probably skew the risk to the downside rather than the upside. When we think about the current environment in terms of tariffs and trade wars, even though we may not be too directly hurt by them, we're pretty, in terms of exports to the US, it's a pretty small share of our GDP. So that obviously there might be certain specific sectors that are impacted, but at an aggregate macroeconomic level, it's not too bad. But our biggest trading partners, of course, are Asia, into China, Korea, Japan, and they are being directly impacted. And so to the extent that trade war may escalate, then there may be weaker demand for our commodity exports to Asia. And that would be a kind of second derivative or second way that our economy might be impacted. And so we think that those risks are skewed a little bit to the downside than they are to the upside. But that kind of gives you a sense of where we think interest rates will go. At the moment, the market's pricing in the RBA to get to around low 3%, somewhere between 3% and 3.25%. But we think it's going to be end up a little bit lower than that
Interesting.
So under that environment, we do think that the RBA will still be, in a bit of a gradualist mode. So things are going okay here. There's no need to panic and slash rates. We just think that the inflation picture has improved. It's going to allow the RBA to gradually ease rates. So under that kind of environment, that's a pretty healthy environment for bonds. When we look at bond yields here in Australia, like the 10-year bond yield, it hasn't really fluctuated that much over the last 12 months, still in the kind of low 4%. And so with the RBA set to ease policy, cut 2 or 3 more times, that starting yield is pretty attractive in our minds. And then on top of that, we can add value by doing, investing in credit and other spread-related securities and all the kind of alpha-generating strategies that come out of our investment process. So, with core bond strategies yielding in the kind of mid to high single digit, that's a pretty good estimate for future expected return. And coming back to those, what I was talking about when comparing bonds to equities, if your kind of starting position is an expected return in that mid to high single digits, or even just mid single digit returns, where inflation's averaging 2.5% to 3%, you're getting a return well above inflation. You're preserving your purchasing power. You're getting a good source of steady income. Again, it's not like equities. We're not going to get double-digit returns, but at least as a starting point, that's a good good source of return. And if things were actually to get worse, if there was a global recession, then there's kind of upside to that. That's when bonds can do even better and capital prices can go up, and you can have high single-digit return expectations. So again, it comes down to having a place in your overall portfolio. There's a place for growth assets, and I think there's a place for, particularly now, for core bonds.
I think if you cast your mind back 5 years or so, maybe just prior to COVID, there was a very different narrative, right? Very, very different narrative to what it is now. And I think if you're a retiree listening to this, if you're building diversified portfolios, it's actually like what you're saying is actually wonderful news, because you don't need to go like way up the risk curve in order to get really respectable returns, right? And I think that's a really welcome change, or it should be, for retirees that might be watching or listening in particular, but also just anyone else that's allocating capital right now. So it's a really good reminder, AT, of where we are in the cycle. And as someone who looks at this each and every day and has done so for a very long time, I really do appreciate you taking some time. I know you're a busy fella, so I really do appreciate you taking some time to share all these insights with myself and the community.
Oh, thanks very much for having me.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.